Hello and welcome to the Investing Iguana, where I share with you my tips and tricks on how to grow your money in the stock market. I'm your host, Iggy, and today we're going to talk about how to avoid the biggest mistakes in investing. Investing can be a rewarding and exciting way to build wealth, but it can also be a frustrating and costly experience if you make some common errors. In this video, I'm going to show you 8 of the most frequent and damaging mistakes that investors make, and how you can avoid them or fix them if you've already made them. Before we get started, please hit the like button and subscribe to my channel for more videos like this. And don't forget to turn on the notification bell so you never miss an update from me. Alright, let's get into it. Here are the 8 biggest mistakes in investing and how to beat them. Mistake number 1, not understanding the investment. This is a basic but crucial rule: never invest in something you don't understand. If you don't know what a company does, how it makes money, what its competitive advantages are, what its risks are, and what its valuation is, you're setting yourself up for failure. Warren Buffett, one of the world's most successful investors, cautions against investing in companies whose business models you don't understand. He says that he only invests in his circle of competence, which means the industries and sectors that he has knowledge and experience in. The best way to avoid this mistake is to do your homework before you invest. Research the company, read its financial statements, listen to its earnings calls, follow its news and analyst ratings, and compare it to its peers. If you still don't understand it or feel confident about it, move on to something else. Another way to avoid this mistake is to build a diversified portfolio of exchange-traded funds, ETFs, or mutual funds. These are collections of stocks or bonds that track a certain market index or sector. They allow you to invest in a broad range of companies without having to know everything about each one of them. Here are 3 high-performing ETFs in Singapore based on our research. SPDR Straits Times Index ETF, SGX, ES3. This ETF tracks the performance of the Straits Times Index, which consists of the 30 largest companies on the Singapore Exchange. It offers diversified exposure to Singapore's blue-chip companies and the overall growth of the country. Lion OCBC Securities Hang Seng Tech ETF, SGX, HSS. This ETF tracks the performance of the Hang Seng Tech Index, which comprises the 30 largest technology companies on the Hong Kong Stock Exchange. It offers exposure to some of the most innovative and fast-growing tech companies in Asia. Lion Phillip SREIT ETF, SGX, CLR. This ETF tracks the performance of the Morningstar Singapore REIT Yield Focus Index, which consists of high-dividend Singapore REITs. It offers exposure to the real estate sector and a steady source of income. Mistake number 2, falling in love with a company. It's great to be passionate about your investments, but don't let your emotions cloud your judgment. Sometimes, investors get so attached to a company that they ignore the warning signs that it's time to sell. Maybe the company's fundamentals have deteriorated, maybe the industry has changed, maybe the competition has become stronger, maybe the valuation has become too high, or maybe you just have a better opportunity elsewhere. Whatever the reason, you need to be objective and rational when evaluating your investments. Always remember, you bought this stock to make money. If any of the factors that prompted you to buy into the company change for the worse, consider selling the stock. Don't hold on to it just because you like it or because you're afraid of admitting a mistake. One way to avoid this mistake is to set a target price or a stop-loss order for each stock you own. A target price is the level at which you plan to sell your stock when it reaches your desired return. A stop-loss order is an instruction to sell your stock automatically when it falls below a certain level to limit your losses. Another way to avoid this mistake is to review your portfolio periodically and ask yourself if you would buy each stock again today at its current price. If not, then maybe it's time to sell. Mistake number 3, lack of patience. Investing is a long-term game. You can't expect to make huge profits overnight or every year. The stock market goes through cycles of ups and downs, and sometimes it can take years for your investments to pay off. Many investors make the mistake of being impatient and giving up too soon on their investments. They sell their stocks when they see a small dip or when they don't see any movement for a while. They miss out on the compounding effect of reinvesting their dividends and capital gains over time. The key to successful investing is patience. You need to have a long-term horizon and stick with your strategy through thick and thin. Don't let short-term fluctuations or noise distract you from your goals. One way to cultivate patience is to have a clear investment plan that outlines your objectives, risk tolerance, time horizon, asset allocation, and rebalancing frequency. This will help you stay focused and disciplined regardless of market conditions. Another way to cultivate patience is to avoid checking your portfolio too often. Constantly watching the markets can make you anxious and tempted to act on every little change. Instead, check your portfolio once a month or once a quarter, and only make adjustments if necessary. Mistake number 4, too much investment turnover. Turnover refers to how often you buy and sell your investments. Some investors think that they can beat the market by constantly trading in and out of positions based on news, rumors, trends, or gut feelings. This is a big mistake for several reasons. First of all, trading frequently generates fees and commissions that eat into your returns. Second of all, trading frequently exposes you to higher taxes on your short-term gains. Third of all, trading frequently increases your risk of making bad decisions based on emotions or biases. The truth is that most investors who try to time the market end up performing worse than if they just stuck with their original strategy in the first place. A well-known study conducted by Gary P. Brinson et al. Covered American pension fund returns from 1974 to 1983 found that 93% of portfolio performance was determined by asset allocation rather than market timing or security selection. The lesson here is simple: don't trade too much. Instead of chasing the latest fads or tips, follow a buy-and-hold strategy that suits your risk profile and goals. You'll save money on fees, taxes, and stress, and you'll give your investments a chance to grow over time. Mistake number 5, attempting to time the market. Trying to time the market is another common mistake that investors make. They think they can predict when the market will go up or down, and they try to buy low and sell high accordingly. This is a very difficult and risky thing to do, even for professional investors. The market is influenced by many factors that are hard to foresee or measure, such as news, politics, psychology, and human behavior. You never know when a black swan event will occur that will shock the market and change everything. Moreover, timing the market means that you have to be right twice, once when you buy and once when you sell. If you miss the best days or months of the market, you can significantly reduce your returns. For example, according to a study by J.P. Morgan Asset Management, if you missed the 10 best days of the S&P 500 between 1999 and 2018, your annualized return would drop from 5.62% to 2.01%. The bottom line is that time in the market beats timing the market. Instead of trying to guess when to buy or sell, you should invest consistently and regularly, regardless of market conditions. This way, you can take advantage of dollar-cost averaging, which means that you buy more shares when prices are low and fewer shares when prices are high. Mistake number 6, investing money you'll soon need. Another mistake that investors make is investing money that they'll need in the short term. For example, some people invest their emergency fund, their down payment for a house, or their tuition fees in the stock market, hoping to earn some extra returns. This is a very risky move because the stock market can be volatile and unpredictable in the short term. You never know when a market crash or a personal emergency will happen that will force you to sell your investments at a loss. The rule of thumb is that you should only invest money that you won't need for at least 5 years. This way, you can weather any market downturns and benefit from the long-term growth of the market. For money that you'll need sooner than that, you should keep it in a safe and liquid place, such as a high-yield savings account or a money market fund. These options won't earn you much interest, but they will protect your principal and allow you to access your money quickly when you need it. Mistake number 7, having unclear investing goals. Investing without a clear goal is like driving without a destination. You'll end up wasting time, money, and energy on things that don't matter or don't align with your values. Having a clear goal helps you define why you're investing, how much you need to invest, how long you need to invest for, and what kind of returns you expect to achieve. It also helps you measure your progress and adjust your strategy if needed. Your goals should be smart, specific, measurable, attainable, relevant, and time-bound. For example, instead of saying, I want to retire comfortably, say, I want to save $1 million by age 65 so I can withdraw $40,000 per year for 25 years. To achieve your goal, you need to have a plan that outlines how much you'll save and invest each month, what kind of asset allocation and risk level you'll choose, and how often you'll review and rebalance your portfolio. Mistake number 8, not diversifying your portfolio. Last but not least, one of the biggest mistakes that investors make is not diversifying their portfolio enough. Diversification means spreading your money across different types of investments that have low or negative correlations with each other. This way, if one investment goes down, another one may go up or stay stable, reducing your overall risk and volatility. Diversification can be done at different levels, across asset classes, such as stocks, bonds, commodities, real estate, etc., across sectors, such as technology, healthcare, energy, etc., across industries, such as software, biotechnology, oil, etc., across geographies, such as US, Europe, Asia, etc., and across styles, such as growth, value, dividend, etc. The optimal level of diversification depends on your personal preferences and circumstances. However, a general guideline is to have at least 10 to 15 different securities or funds across different asset classes and sectors. You can also use ETFs or mutual funds to diversify your portfolio easily and cost-effectively. However, diversification has its limits. You don't want to over-diversify your portfolio to the point where you own too many investments that are similar or redundant. This can dilute your returns and make it harder to manage your portfolio. To maintain a well-diversified portfolio, you need to rebalance it periodically. Rebalancing means adjusting the weights of your investments to match your desired asset allocation. For example, if your target allocation is 60% stocks and 40% bonds, but your actual allocation is 70% stocks and 30% bonds due to market movements, you need to sell some stocks and buy some bonds to rebalance your portfolio. Rebalancing helps you keep your risk level in check and also allows you to buy low and sell high. There are different ways to rebalance your portfolio, such as using a time-based approach, example, once a year, or a threshold-based approach, example, when your allocation deviates by more than 5% from your target. Whatever method you choose, make sure you consider the costs and taxes involved in rebalancing. So there you have it, 8 of the biggest mistakes in investing and how to avoid them. By following these tips, you can improve your chances of achieving your investing goals and growing your wealth over time. I hope you enjoyed this video and learned something new. If you did, please give it a thumbs up and share it with your friends. And don't forget to subscribe to my channel for more videos like this. Thank you for watching the Investing Iguana, and I'll see you next time. Happy investing!